Okay, so we have now covered the different type of adjusting entries that have to be made at the end of the accounting period. We have posted those adjustments to the appropriate ledger accounts, and now we prepare the adjusted trial balance. This is prepared to prove the equality of our debit and our credit imbalances after we have made the required adjustments at the end of the accounting period. Now from the adjusted trial balance, we can now prepare our different types of financial statements as well as complete what's called the closing entry process. Okay? So we'll look at the income statement, the retained earnings statement, as well as the balance sheet, and these statements are prepared directly from the adjusted trial balance. So first, for the income statement, the revenue account and the expense accounts, they're all coming from the adjusted trial balance to determine whether we have a net income or a net loss. That net income or net loss is then transferred over to the retained earnings statement. The beginning retained earnings, if you follow the arrows, is coming from the adjusted trial balance. That amount was 0. Any dividends, again, follow the arrows, are coming from the adjusted trial balance. So we take our beginning retained earnings, add in our net income, less dividends to get ending retained earnings for $2,360. Next, for the balance sheet, all of our assets are coming from the adjusted trial balance. Remember that accumulated depreciation is a contra asset account subtracted from the equivalent account to get its current book value. You would then add the book value amount to the other asset to get total assets on the balance sheet. Your liabilities are all coming from the adjusted trial balance to get total liabilities. The common stock is coming from the adjusted trial balance. Now the retained earnings ending balance is not coming from the adjusted trial balance. This figure came from the retained earnings statement we just prepared. I'll show it to you. You see that? This $2,360 here is then transferred over to the equity section of the balance sheet. And as we all know, the balance sheet must do what? Yes, it must balance. So when you add your liabilities plus your stockholders' equity, they must equal your total assets, and they do. Both sides total $21,910. Okay? So we've now prepared our statements for this current accounting period. We're ready to cook the books. Close the books. We're ready to close out the current accounting period to get prepared for the upcoming accounting period. So there are certain accounts that are temporary. Excuse me, I had to sneeze. Gesundheit. Thank you. I had to bless myself. Others are permanent. Now, when an account is temporary, what does that mean? It means that the account only shows balances for the current accounting period. The account will be closed given a 0 balance at the end of each accounting period. So your revenue accounts, expense, and dividends are all known as temporary accounts. So to put things in perspective, think about your W-2 form that you receive each year. That W-2 shows the amount of income that you earn for that particular year, let's say for 2020. Now, when the next year comes around, 2021, you begin with a 0 balance because it is a new accounting period. Okay? So when accounts are temporary, they only show the balances for that particular accounting period. they're going to be closed out at the end of each accounting period. Closing means that these balances are going to be transferred over to a permanent account, which is going to be retained earnings. To put things in perspective, look at the retained earnings statement, right? How do I go from the 0 to this 2,360? It's by adding the net income, right? Which consists of revenues and expenses, as well as subtracting out the dividends. So in essence, we're going to go through the process of transferring the revenue accounts, expense and dividends to determine the retained earnings in the balance. So we know already that amount should be this 2,360 once you're done with the closing entry process. So back to the closing entry process. It is a 4-step process. We're going to close out our revenue accounts and our expense accounts to an account called the income summary account. We'll then close out the income summary account and dividends to retained earnings. So again, it is a 4-step process. You'll close out your revenue accounts, go back to income summary, close out your expense accounts to income summary, then close out the income summary account to retain earnings, and close dividends to retain earnings. At the end of this process, your revenue accounts, your expense accounts, the income summary account, and dividends will all have a 0 balance. We have a closing entry acronym. We call it REID, R-E-I-D. The R, revenue, expenses, income summary, dividends, R-E-I-D, REID. So once you completed those 4 steps, any account that is temporary will now have a 0 balance. All right? So again, the first step is to close out your revenue accounts. Your revenue accounts have a 0 balance. Also have a credit balance. In order to close them out, you would debit the revenue accounts and then credit income summary. Your expense accounts have a debit balance. In order to close them out, you would credit each expense account the amount required to give them a 0 balance, and you're going to debit the income summary account. So step 1 was to close out your revenue accounts. Step 2 is to close out your expense accounts. All right? So after step 1 and 2, think about this. Income summary, we credit for $10,600. Income summary, debit for $7,740. Which means after these first 2 steps, let me get out my calculator, it means that the income summary account has a balance of $10,600. Oops, that's my count, not my calculator. $10,600 minus $7,740. So income is showing a balance of $2,860 on the credit side after these first 2 steps. Now, the income summary account is also temporary, meaning that it too has to be closed out. Since the account has a credit balance, we're going to debit the income summary account, the $2,860, and credit retained earnings. In essence, what have we done? We've just transferred the net income earned for the accounting period over to retained earnings by closing out the revenue accounts, the expense accounts, and the income summary account. The fourth and final step is to close out your dividend account. To do that, we'll debit retained earnings for $500 and credit dividends. That's because dividends increase on the debit side. In order to close them out, we'll credit the account the amount required to give it a 0 balance and debit retained earnings. So these are the 4 steps of the closing entry process, better known as READ. Close out your revenue accounts to income summary. Close out your expense accounts to income summary. Close out your income summary account to retained earnings, and close out your dividend account to retained earnings. At the end of these 4 steps, once you pull to the ledger account, your revenue accounts, expense accounts, income summary will all have a 0 balance. Now, retained earnings account is permanent, so that account will not have a 0 balance, because when an account is permanent, it means the account balance will carry forward from one accounting period over to the next. So again, here you can see that now all of the expense accounts are at 0, the revenue accounts at 0, income summary is a 0 balance, dividend 0 balance, retained earnings again is a permanent account. So now it reflects the ending balance for retained earnings after we have closed out all of the temporary accounts. Okay? So that pretty much concludes the accounting period. We have now completed all of the adjusting entries. We prepared the financial statements. We've done the closing entries. We can now close out this accounting period and get prepared for the upcoming accounting period. Okay? So I hope you have enjoyed this lecture covering Chapter 4. Bye-bye.